Welcome to the Bold Property Podcast, where informed decisions shape stronger property portfolios. Your hosts are Karl from the Barnard Group and Cameron from The Way to Invest. Each week they cut through the noise and guide you to invest with clarity, strategy, and confidence.
Well, Cam, we are back for episode 3 of the Bold Property Podcast. How's your week been?
It's been an interesting one. It's been fun. It's been buying lots of properties for clients, but it's definitely a rat race out there, I guess, in the context of, the amount of demand out there and people are paying top notch for lots of properties.
Yeah, it's been busy out there, and watching some of the numbers are extremely interesting. Some of the numbers are running a lot hotter and faster than the data suggests, but I think we touched on it last week, but there's a lot of risky behavior going on in this market, especially first-time buyers who are now cashed up and buying with emotion are tripping over each other, and there's a bit of fear of missing out. And I've been part of a couple of deals where I had a look at some of the building pest inspection reports that were provided by the agent, and they were severely lacking. But first-time buyers don't understand that. They just accept it at face value, and they pay top dollar for properties in areas that 2 months, 3 months ago, no one would consider.
Yeah, I'm the same. I find that people are, I wouldn't say getting picky. It's probably more the other way around. It's more that they're just going to chuck their money at anything and sort of hope for the best. I went to quite a number of open homes in the weekend, and, one was presented nicely. It was a 2-bedroom. And it was just very much that you could see there was structural damage. It was on a large block, which was good. And this was in Gordonvale. They were wanting offers that were over $649, and from the data suggesting that it's not worth that for a 2-bedroom place. There's another house around the corner, nowhere near as up to sort of standard as this house, but they were wanting exactly the same. However, it was 3-bedroom, definitely needed a bit of work. There's currently tenants in there that, we're doing an okay job, but for it to be the same price, it's just people are paying it. This is the thing that It is so strong. And, the amount of people walkthroughs, some of the way that the agents are handling it too, they're brutal. Some of them, like you can tell the ones that aren't fans of buyer's agents, not all of them. But I would like to remind them that markets change and, buyer's agents are going to be here. We will have your clients that you'll be calling us. Do you have buyers for this property? Once that changes. So, look, let's please work together to help out for our clients as well as we're helping out for your clients too. So I think fear of missing out is definitely the flavour. It has been a flavour for a long time. I think we are going to touch on an article that we've recently read, and white noise could come into play, but this isn't going away. 2026 is going to be another huge year for property growth. There is nowhere in sight that it's not going to be, and most markets are going to be quite positive, I feel.
Yeah, and I mean, back to the buyer behavior, right? And some of the agents, property, a lot of the property prices, as you say, data's not supporting that. They're sticking a high sticker on that. I've seen properties where, they were going for $850,000 a month ago. They're now putting prices on there saying, hey, offers over $950. And a month ago, you buy that for $850. And as you said, people just go take it on face value, especially first-time buyers, because they suddenly have an influx of cash. They're driven by emotion. They're driven by competition. If you go through an open home, there's 30 couples, all of them have young kids, and they're just eyeing off their competition. For them, it's that emotional drive to get in, and they are literally just throwing money at it, and they're taking prices at face value. So we have a significant imbalance between supply and demand in this market. I mean, in addition to rate cuts, in addition to the first-time buyer deposit scheme, we also have listings below, historic highs, or they're lower than they usually are. So I think we're 20% under, in terms of listings compared to the historical average. So there's a significant supply-demand imbalance. But what that means for investors at the same time is because prices are growing so fast, rental demand isn't keeping up. So we're seeing deterioration in some of those yields. So I think the question is, right, looking at the data, we're looking at the supply demand, we're looking at the cash in the market. I agree. I think property prices are going to continue, growing into 2026, regardless what the RBA does with their interest rates. Even if they hold interest rates steady, I think the market is still going to grow and grow extremely strong. If we do see a cut, it's going to get worse than it is right now. So what should property investors do in this situation?
Get in. Get in the right areas, obviously. Don't just wing it and say, I want to buy here just because I can. Do your research. Make sure that you're buying it, but have a strategy. I say this all the time. What is your strategy? Work it out. What is your end goal? Just because it's hot doesn't mean that the markets aren't going to change. It's all going to go in cycles. In 5 years or 10 years' time, we're going to be talking about completely different subjects. And, but we don't want to be talking about, geez, I wish I bought back in 2025 in November or December, or I wish I bought in the start of 2026. Be in there now. Be in there so that you've said, oh, geez, I've made such a great purchase now. I've actually doubled the value of my equity in this property I've bought right now, instead of saying, oh, I wish, and then I listened to the guy that was just waiting for the interest rate cuts to fall. So get in now, work out your strategy, work out your borrowing capacity to make sure that you're making that right decision, and get a team of experts behind you. They're the ones that are going to help you make that right decision. And whether it also comes into where you're in that position in your life. Like, some people want to look at investing in property at 50 or 60, and that's fine, but that's part of their strategy for what they want to do in retirement. Then you've got the build phase where you're in your early 20s, your 30s, and even your 40s, where you're trying to build that portfolio up to get to that point. So work out where you are at your stage, get into a proper, a financial mortgage broking team or finance advisors, and they can work out where your best strategy is and what you want to reach with your goals. I love going on holidays every year. I don't have kids. I know a lot of my clients have kids, or they want to have more kids. What do they want at the end? So that's something we sit down and work out. And that's the key to it, I think, is having that proper strategy.
Yeah. And you touched on an important point, right? It's getting into the market, but doing so in a smart way. I tell my clients, let's not play the FOMO game. Property investment is a very long-term investment. And yes, we don't want to be getting in, mid next year when the markets have moved. So what we're doing now for a couple of clients is we're actually looking at their budgets. We're looking at income, expenses, the yields they need to achieve. And some of the areas, we were looking at getting into, we were getting finance ready. All of a sudden they had this jump and yields went from a 4.2% to 3.7%. There was another property we looked at and the yield was going to be 2.7%, right? You just go, well, at that price point, those are extremely low yields. Obviously, as you step up in price point, high threes, low threes, that's not uncommon. And what we're looking at now is, well, could we utilize that budget and should we shift the location in which we're going to invest in? They're investors, they're not married to a location. We don't want to go and fight with people who are buying with their hearts and not their heads. So we're taking a step back. We're looking at the strategy and we are looking at determining if there's another market we can put them into with their budget where we can get better yields, still going to serve them in the long term, but we're not going to make a mistake where, the last thing you want to do is get into a property and not be able to afford that property. So it really comes back to being smart. And then again, when the market starts moving the way it does now, it can be very easy to get caught out, get overexcited, that fear of missing out, get a bit nervous. But, if you need to take a step back, take a couple of weeks, figure out your strategy, regroup, in 10 years' time, it's really going to pay off. SKM Research just released a bit of data they are doing a bit of a forecast on the markets for next year. So in terms of their worst case outlook for growth, Sydney and Melbourne would grow by 2 to 6%, Perth will grow by 14%, and Brisbane will rise by 12%. So that's their worst case outlook looking at the data. If we were to get a couple of more interest rate cuts, it changes that outlook significantly. And best case scenario for them is Perth going up by 21%, Brisbane and Darwin by 18%, Sydney and Melbourne by 11%. So double-digit growth, sort of best case scenario. But even the worst case scenario is significant growth coming into the market. And I think what's interesting is that's at a national level, where over the last couple of years, we've had different markets move at different rates. Some of them haven't moved at all. Some of them have sort of gone slightly backwards. But we're now seeing a significant shift in the property market landscape nationwide, which just talks about that difference between supply and demand. And I saw another article the other day where we are falling behind on the number of houses we need to build, and we can't get it done fast enough.
Exactly. And that's not changing. I think that where are we going to find the next affordability areas, regions that we're going to buy? I mean, the affordability of ways in areas that we're looking in is probably like Tasmania at the moment, certain pockets in there, and they've got some great developments. I know there's some areas in Tassie that I'm definitely looking at. And, but they're going to get to that point where we are in other regions of Australia. And what point do we get to where we say we can't afford to buy houses? I mean, not everyone's going to be in that situation, and we're all at different stages again. But yeah, where are the affordability points going to come to when Australia wide we could be at $1 million buy-in point?
And in terms of the capital cities, we're moving up to that really quickly, because what history tells us, if more money comes into the market, the housing market absorbs that money really quickly. And I mean, we're seeing that now with first-time buyers. I'm going to use Brisbane or Queensland as an example. All of a sudden, they can spend up to $1 million with 5% deposit, and the market's just absorbing that in terms of rapid price growth. And we're probably going to see a massive rush up to that $1 million mark, and then that's going to become the new norm for first-time buyers. So, we're going to start talking about smaller capital cities. We're going to start talking about regional areas. But another thing that needs to be considered is just because something's cheap doesn't mean that it's good. And a big part of that is understanding, well, why is an area cheap? And what are the key fundamental drivers that's going to bring money, job growth into a certain area? And I've heard this recently. A lot of people bought apartments in Melbourne, and I go, okay, why did you buy the apartment? They go, oh, it was so cheap. Yeah, well, it's not a good reason to be buying an investment property. Probably cheap for a reason. What are the fundamentals underpinning, in this example, the Melbourne apartment market, where you see future growth? And people couldn't answer that question. So I think there's a lot of mistakes being made in this market on both ends. And I think in 6 months' time, the news articles are going to come out where people have been burnt because they were rushing into a market. They were buying with purely their hearts, and they made some mistakes. And obviously, our job is to ensure that our clients don't make those same mistakes.
The other thing is owner-occupiers. This is not mainly geared towards them because that's a lifestyle choice. And, if you want to live in, Cairns or Melbourne or Brisbane or Sydney because you love the lifestyle of that area, go for it. And, owner-occupiers in the market are a great thing. It's a great thing for investor too. We're looking at different vacancy rates coming into different areas as well. And a lot of people touch on areas in Melbourne that I find quite interesting. Their vacancy rates are sitting up around the 3s and the 4s, and they're saying it's a sort of a good place to invest. I struggle with looking at those numbers to see the potential of, that as a good investment, looking at the long-term data, it doesn't suggest that it has been. I don't think I'm reading it wrong.
Cheap? Are these cheap markets to buy in?
We're looking at the Werribees.
Yeah.
So, they're going up as well, but, there's certain parts of Geelong as well that got the higher vacancy rates as well. And there's lots of demand for those areas, especially from investors too. But if I could avoid that, I certainly would.
Yeah, 3% is considered a balanced market when it comes to vacancy rates. Everything over that means you're going to struggle a bit more to rent out that property. Anything under that, there's an insane amount of demand. So you're quite right. If a lot of investors start piling into an area that already has higher vacancy rates, well, you're going to have to start dropping your rent in order to get a tenant in. Now, if your goal is purely capital growth and the fundamentals are there, that could still work. But again, it's one figure. And I think a lot of people overlook the fundamentals. They look at historical growth. They might look at a vacancy rate and they go, I'm going to buy, or it's cheap, right? And they're going to buy in those areas. But what's underpinning the fundamental growth for those locations? So it's just one more data point. But you're right. People are making decisions without really doing their research, and they're jumping in because there's a news article out or other people are doing it, or because they can afford it, not because it's a good investment.
Yeah, exactly right. Yeah. I also look at other markets in Victoria and, people don't always agree with me on these markets. However, I see the potential of them that they're like the Latrobe Valley region out in Gippsland. I look at it that a lot of clients there that I am buying for in there, it's that their affordability. So that's one point. But there is the infrastructure going out there too. So you can get some really good properties out there. I was out there a couple of months ago, and it's a beautiful part of the world. Some parts of it, the socioeconomics aren't of great, but there's very much good vacancy rates. You've got some good capital growth happening there, and we've also got some good rental yields in there. And rental yields are quite significant there, so that's a positive when it comes to investing if you're part of that, wanting that extra cash flow over the capital growth.
It comes back to doing your research, because those areas might not be on an investor's radar, but sometimes those make the best investments. You want to get in before the rest of the market catches on, before they hit the news. And it comes down to understanding market fundamentals, what properties are worth, what the growth drivers are. And you touched on infrastructure, which is a big thing. What's going to drive jobs, what's going to drive demand for property. And if you can balance that with great yield now when you get in, you ride that capital growth wave. And it's a lot easier to hold on to those properties because you do get better cash flow from them. And that really helps you sustain your portfolio over the long run. So I think to anyone listening, if you're currently looking at a couple of suburbs, prices are absolutely horrendous. Stupid offers are being thrown out. Yeah, you're competing against risky behavior, which is certainly what I've seen, where we want to be smart about that investment, and people are happy to forego building pest inspections. And obviously the sellers love that. But I would never buy a property without my own building pest inspection, not one that's being provided. If that means we lose out on a couple of properties, then so be it, right? Because if you step into a property, you didn't do building a pest inspection, and let's say it's relatively small, right? The waterproof barrier in the bathroom is failed. That's at least going to cost you $15,000 to replace that bathroom. Let's say it's something major, that the property is infested with termites. Well, that property needs to be knocked down. And even if you've got a building pest inspection report that says there are no termites, because you're not the one who bought and paid for that report, you are not covered. You are ruined financially, right? So if that means it takes us a couple more weeks to get into the property market, but we do so smartly, or we need to move to another area where we can get in, still get a great investment, but not be silly about it, that's rather the approach we take than play the Hunger Games, because it's the Hunger Games out there, right? You've got a lot of cashed up first-time buyers. They are trying to fight it out. And as an investor, you're trying to sort of jump in there. But you've got a bit more knowledge. You've got a bit more understanding about what makes a good investment, what are risk-based approaches when buying property, and you're against people are throwing money and they're not doing that. So I wouldn't be disheartened if you're an investor. The Australian property market is extremely big, and you might just have to bide your time, or you might have to move into the right market, because we're buying now for the growth coming in the next 10 years, not the growth that's going to come in the next 4 weeks. So I think my advice would be very, very diligent. Don't partake in this risky behavior just to get into the market. And although the market's going up, do so smartly and sensibly when you try and get in.
Yeah, I agree. Just be sensible when you're buying your property and doing it correctly. Another point I want to touch on is like when you're buying in different states, they have different rules. And we all know that, when you bought in Queensland, not long ago, we brought in the seller's disclosure statement, the Form 2. Going into Victoria, you've got the similar form, but it's called the Section 32. And then buying in Tassie, they have different rules. Buying in New South Wales, they have different rules as well. So it's also knowing about the different markets and how they operate when it comes to contractors. I always recommend having a conveyancer that works in that state to make sure that they know the rules. And you've got conveyancers, and I'm sure they're great, but that's my own preference for my clients, is to make sure that you have that right conveyancer in that state, just so that you're getting the full knowledge, I guess you could say, of how things work there.
You're right. Every state is different. Victoria has a lot of rules around land tax, but it's also their minimum rental standards, which are extremely strict. And you don't want to buy a property and then go and have to spend $10,000, $15,000, getting it ready for tenants if you weren't expecting that cost. And you're quite right. Find a really good conveyancer in the state. Also find a reputable building pest inspector. And I probably can't hammer on this enough, but also understand that a building pest inspection report only looks at the property. There could be a lot of contributing factors that play into that. They won't tell you if there's an easement on the property. They won't tell you if there's an apartment block coming up next door. That's a lot of additional research you need to do and a lot of additional effort. So you can't just rely on the building pest inspection report. You might not know whether next door is public housing. So there's a lot of research that goes into your state, your LGA, your suburb, your property. And as an investor, you need to be educated. You need to be smart about the way you go about it and really do your homework. It's going to be one of the biggest expenses or purchases in your life, and making a mistake can be extremely costly. So let's get on to bold statements of the week. Cam, what's your bold statement of the week?
Mine is, we're heading into a market where today's prices will look cheap in a year's time.
My bold statement, very related. Australia is about to enter new price surge driven by demand and undersupply, not just interest rates.
I think they're both very bold and both very accurate.
Absolutely. I think that's very realistic. So I think the key takeaway from today's podcast is market growth is coming. The data tells us that there's significant growth coming. We're already seeing significant growth in certain areas. And if you were thinking of getting into the property market, do so sooner rather than later, because the market doesn't wait for you. But at the same time, be sensible and smart about the way you're going to do it. Don't partake in the Hunger Games.
Yeah, I think that's great advice. Be smart, be wise, make the right choice now to set yourself up for the future.
Thanks for listening to the third episode of the Bold Property Podcast. We'll see you on the next one.
Thanks for tuning in to the Bold Property Podcast. If you found value in today's episode, share it with someone who wants to make smarter moves in the property market. For more insights and support, connect with Karl at the Barnard Group or Cameron at The Way to Invest. Join us next week as we continue to break down the market and help you invest with clarity and confidence.